Good morning, everybody. I think in the interest of time and for the benefit of those online as well, who are following us from afar, we would like to start our second day. So as Noelia closed the day, congratulations for being back here, because we had a very long day yesterday. You survived the first day, which was very dense and very insightful in terms of conversations. For those of you who have joined today, I'll do a super brief recap before we delve into the topic of the role of insurance. I'd like also to profusely thank the Bank of Spain for their welcome and their hospitality. It's been amazing. And we learned a key fun fact yesterday that water in the Bank of Spain is being used as a risk protection mechanism because the vaults that sit 35 meters below our feet actually have a capacity to be flooded in case there is a break-in. So for those of you who haven't watched it, apparently Casa de Papel tells you all about this and shows it in practice. So yesterday we talked a lot about water risks, and I think there was broad consensus about the fact that they are material. We then looked at how different central banks are already doing something about it, and we heard a very powerful message from the sub-governor of the Bank of Spain, Soledad Núñez, who effectively said that, you know, for her, the Dana, the catastrophic flooding in the Mediterranean, had been a wake-up call and very instrumental in bringing the attention at the highest level of the institution on water-related risk, which is why we are here today in many ways, because we've been able to organize this meeting here, bringing people from around the world with central banks hailing from Chile, from Georgia, from Morocco, from, of course, Europe, the European Central Bank, which is leading the way on this topic and has been holding the first sort of face-to-face meeting of their water group here just the day before we met. So we heard not only from supervisors, both on banking side and insurance, but also from the Ministry of Environment here, from the public development banks, and from investors. So I think what we're going to move towards today is looking at instruments and the roles of other type of actors, starting with the critical role of insurance, and I'll hand over to my colleague Laila Davis to moderate this panel, and we'll then discuss the critical role of pricing as well of water-related risk. I think one thing that I didn't hear yesterday was the importance of pollution risk, which shows that we still come at it with a framing that is very much inspired by climate discussion, with a strong focus on droughts and floods, and for example, that was not discussed almost in the discussion on fiscal risk, whereas PFAS, for example, do represent a very substantial investment need, and that may be something you can pick up on, Christopher, at some stage. So I think we hope to make today a lot more interactive than yesterday. After these two sessions, we have a session that will be led by Kate, and I think we can rely on her to wake us up. And so please come at it with ideas about what you would want to go into this roadmap for action, both at national and international level. So keep thinking about that, what needs to be done within a year, within 5 years, etc., and who should do what, because this is the key thing that we want to get out of this meeting, and that will feed into a policy paper and recommendations formulated by the OECD, and potentially to a declaration or some kind of outcome document by central banks or others in the UN process. Let's bear in mind that, you know, at the end of the year, the UN Water Conference is a big moment for water. So what can we take to the UN conference in order to effectively show that, you know, things are happening on the central bank side and what needs to happen next? With that, I'll leave it to Laila. Thank you.
So good morning, everyone, and welcome to session 5. As Sophie said, I'm Laila Davis, policy analyst at the OECD, coordinator on the OECD side for this roundtable, and I was lead author on the report embedding water-related risks in financial stability frameworks, which underpins this, some of the discussions in this meeting. I'm going to take the opportunity of being up here just to really say thank you to Banco de España for the gracious hosting and for being fantastic partners throughout this whole process. Thank you to Juan Carlos, to Noelia, and to Matilde as well for the excellent collaboration, and of course to CDP and NGFS as well. So it's a pleasure to be moderating this morning's conversation on the critical role of insurance. As Sophie mentioned, over the past days, this meeting has been looking at how water-related risks transmit to the financial system through banks, through investors, through sovereign balance sheets. The insurance and reinsurance sectors have a distinctive role. They underwrite the risks directly, seeing loss trends earlier and more granularly than other actors. And increasingly, they're being asked not just to absorb losses, but to also help shape the conditions that determine whether those losses materialize at all. So in our report, actually, we acknowledged insurance as a transmission channel for water-related financial risks, but this session is really an opportunity to explore insurance trends. So where pressure is increasing, where protection gaps may be widening, and to examine the implications for financial stability assessments, which may not be fully capturing some of these dynamics. So in this session, we'll move through the current insurance landscape, and then we'll go towards opportunities for addressing critical insurance challenges. So before I start, 2 quick housekeeping points. The session is being recorded and will be available on the OECD website. In addition, we'll do our best to keep on time and leave you some time for questions at the end of the session. So do start thinking those already. So we have an excellent panel to have this conversation with. I'm delighted to be joined here by Nicolas Jeanmat, Head of Personnel and General Insurance at Insurance Europe. I'd also like to point out that Insurance Europe have developed an excellent position paper as a background note to this meeting, and I invite you to take a look at this. It's linked on our website. We also have Francisco Espejo Gil, Deputy Director of Economic Studies and International Relations from the Consorcio de Compensación de Seguros. So really keen to hear more about Spain's public-private model. And then, of course, we have Esther Bauer, Director of Switzerland and Global Market Development from Swiss Re, with the reinsurers' global view. Thomas Degas, Group Nature Lead at Aviva, an insurer that's been very public about the limits of insurance alone, so very keen to hear your perspectives. And Christopher Gasson, Managing Director of the Global Water Intelligence, and who's just come out of 3 days of the Global Water Summit, which was here in Madrid just 2 days ago. With, I believe, 1,300 participants discussing the theme of accelerating the water transition under capital, climate, and demand pressures. And so this morning, he's going to bring some of the perspectives from that meeting to this discussion through the insurance lens. So let's start. Turning to Nicolas first. Insurance Europe really has visibility across a wide range of European markets in a context where water-related losses are increasing. So from your perspective, what is the sector actually seeing in loss trends, in pricing, in the availability of coverage, and where is the pressure on solvency and underwriting becoming most acute?
Mm-hmm. Thanks very much, Leila. And also from my side, first of all, a big thank you, muchas gracias to the Bank of Spain for the reception and to the organizers for having me here. It's a very wide question that you asked. I'll try to point to a few facts and maybe a few comments, and then I'm sure that my colleagues on the panel will complement. First, I think it has been mentioned yesterday repeatedly by several speakers. Flood risks is the #1 risk in Europe, and it is a risk that is affecting all parts of Europe, albeit in different ways. And we are seeing that in the figures of economic losses and insured losses. And we are also seeing that there is an increase in severity and frequency of events, and we have a lot of examples that can be referred to. Of course, Valencia, the R Valley, and affecting also Belgium and Luxembourg and the Netherlands. We had also floods in Central and Eastern Europe, and this winter significant floods in Portugal, Spain, and France. And there is clearly a link with weather changing patterns. For instance, in the case of France, the affected areas saw 40 consecutive days of rain, which is something that Météo France had never recorded since measurements existed. So there is clearly an important element there. We are also seeing that droughts are increasing and affecting increasing parts of Europe, and that is having consequences for economic activities in agriculture, industrial activities, and others. And in terms of risk, there is also a link with a growing risk, which is resilience, subsidence, where you see cracks in houses as a result of certain types of soils shrinking and then expanding. So drought is another aspect. I think we will increasingly have to look at the interconnection between risks, especially with severity increasing. For instance, if you take wildfires are a peril in itself, but they can also have in turn an impact on floods, landslides, avalanches, beyond, for instance, human health with air pollution or biodiversity loss. So these interconnections are something being increasingly looked at. Sophie mentioned water pollution. It's something that will not necessarily affect directly property insurers, but is something that liability insurers may increasingly look into, and the extent to which certain risks can be insured and at what conditions with water pollution, for instance, PFAS-related increasing. So these are just a few elements, maybe a few important comments by way of setting the scene. One is that, and you mentioned that in your introduction, in its traditional role, insurers is a risk transfer mechanism, and this role is being played at the end of a chain. We tend to speak of a sort of triple protection approach, where you have first prevention, then intervention, then risk transfer. Prevention is, for instance, related to questions like risk exposure, like value of the assets and where you build, vulnerability, so that would be how you build. Then you have the intervention, so the cost of a damage can have a lot to do with how fast intervention is happening. And then you have, at the end of the chain, if you like, this element of risk transfer. So the point I'm trying to make is that the cost of an event and therefore the price of insurance is also very much related to things which are being done on the prevention side and the intervention side, on which a lot of actors have a role to play, and also insurers in their advice capacity. I would like also to mention that, of course, there is a link between the events that we see and climate change, and that's a logical consequence of what I just said. There are other factors that come into play, like where you build, how you build, the value of the assets, urbanization, and also things which have been mentioned yesterday, like hydrology, so nature-based solutions, quality of soils. All of this will, in the end, also have an impact on the severity and the cost of losses. I would also like to stress the important local or national dimension of many of these questions, because you asked about trends in terms of pricing, etc. You can give general trends, but you also need to look into things that are happening in the national context. So, for instance, whether you have a scheme like the consortium in Spain or not, the extent to which a particular country is exposed to certain risks, but also the quality of measures being taken in terms of land use planning, building codes, or intervention. All of these things really are important and have to be taken into account when trying to look at trends in terms of protection gap and these sort of things. And so maybe in terms of, as a summary, clearly there is an increase in frequency and severity of events, which is raising questions in terms of availability of insurance or affordability of insurance for certain risks in certain areas. I would say, globally speaking, that insurance remain available across Europe as a rule. There is a protection gap issue, but it needs to be looked at in detail. What's the source? But in general, I think insurance remains available. And also, I would say that I'm not aware of a solvency concern. So we have a system which is based on very strong, solid prudential rules in Europe. We also have an important distribution of risks, with reinsurers playing an important role as well. So I don't think that that solvency is a particular concern, even with the increase that we are seeing in terms of events.
Okay. Thank you. Some really key points there about different risks, flooding, drought. I'm grateful for you to having mentioned pollution, which which for us is always a key priority. Also local and global dimensions, both in the risks and the interventions, and this important distinction between focusing on transfer of risk and risk mitigation. So let's go from the market overview to firm level signals. So Aviva is at the intersection as an underwriter, asset owner, and also a vocal public voice on climate adaptation in the UK and beyond. From where you sit, where is the water-related protection gap actually opening? We heard from Nicolas that in Europe it's remaining, there is an issue, but it's remaining relatively strong in terms of insurance coverage. But so where do you see this protection gap opening up fastest from your perspective, and how are the signals you see on the underwriting side starting to feed into the investment side?
Great, thanks very much, Leila. That's a lot of questions, but I'll try and do them justice. First of all, thank you to the Banco de España, I think, for hosting and for yesterday. And I think for those of us that were lucky to go on the tour of the building yesterday, we managed to see a beautiful piece of art by some of the children from Madrid, and made me think of reflecting what we heard yesterday. I think it was quite clear from the speakers. We've gone past the golden age, or rather the Goldilocks age of water, where it's not just right, but we have too little or we have too much. And in the UK, we're exposed to that as acutely as those in the rest of Europe. So I want to focus on flooding and build on what Nicolas said, and particularly provide a UK perspective of what we're seeing, the protection gap, but then also the trends going forward. So in terms of the UK, what we're already seeing is flooding is a growing, not just risk, but is being a realised impact. If you look at annually what the total cost in the UK is of flooding, it's around 6 billion per year, and that's been growing. And as part of that 6 billion, what we're seeing in terms of average insured claims being paid out, those have also risen. So they've been steadily rising. They were up 6% last year, with the average claim around £30,000. Now, those are the kind of big numbers, and what I really want to do is kind of actually explain or pick out how this actually is impacting household balance sheets at the micro level in the UK, because I think that's when we really start to understand the transmission mechanisms, but then also the vulnerabilities that are there. So if you look at the average flooding event in the UK, and if you look at repair damage or costs on average, it's between 30 to 50,000. Now, that's just a number. In perspective, the median median household income in the UK is just north of 30,000. So you're looking at a whole annual income for a household, and thereby needing to dip into savings. Now, also as part of that, when you look at the average property prices, that 30 to 50K is roughly about 10 to 20% of a home value, and that's today. That's not in the future. That's not how physical risks are impacting. That's the impacts we're seeing today. And of those events in severity, when houses are flooded, people or homes are displaced for between 9 to 12 months. So this isn't just an event happens, people move out, that affects their employment, that affects in terms of our economy, human capital, and the ability to get back to work. So there is a persistent shock that households face. Now, when a flood happens, obviously it doesn't just hit homes, it hits other physical assets for households, and particularly vehicles, so also a motor insurer. And also if you look at what's happening to motor insurance in the past few years, most recently more than half of motor insured claims had to be fully written off because of the extent of the damage. So homes are being hit, other assets such as cars are being hit, and so really what you're seeing is multiple shocks to household balance sheets and persistent shocks that only impact over time, as that can also impact employment and their availability to work. So what does that mean in terms of a protection gap space? And that's what you asked. For those, and apologies, I might just be saying what people know of what the protection gap is, but the protection gap can be thought of the economic losses that occur, how much is currently insured, so how much could you claim back. If you look at the UK, it's around 30%, so what that means is the bulk is still insured, 70%. But crucially, that number, the gap has grown. So about a decade ago, it was around 20%, and that's grown to about 30%. Now, again, that's an absolute figure. In relative terms, and particularly in Europe, the protection gap is around 30%. You probably have lower in certain economies such as Japan, but higher in terms of Canada and the US, where the protection gap's already higher. Now, in the UK, that level of around 30% can be explained in terms of relatively still low, I would say, by two things. One is the UK is quite a mature insurance market. There's a huge amount of market penetration. We as Aviva in the UK, 1 in 4 people have a Aviva product, so you can proxy that for how many people actually have insurance in the UK. The second, which I think we'll come back to in the next round of questions, is also the existence in the UK of Flood Re, which is a reinsurance program, which is a public-private partnership to help those already in high-risk zones of flooding, make sure that flooding insurance is more affordable. So thereby that also helps mitigate a growing gap. But lastly, in terms of the direction of travel, I want to make a critical point about what would drive a growing protection gap over time. And I want to make a point about exposure of existing stock, particularly houses, but then also new builds. Where are we building new homes that could be exposed? So in the UK as it stands, right as of today, around 6 million homes are at risk of flooding. Now, it's expected, if you look at the Environment Agency or government estimates, that would rise to about 8 million on central estimates by 2050. And that's of current housing stock. So if we do nothing, if we build no new houses, or if we build them where they are, the risk will rise. But what we've also seen in the past 5 years, 5 to 10 years, is we're building houses still in places that either today currently at risk of flooding or will be. So in the past 3 years, 1 in 9 new homes in the UK have been built in an area that's either moderately to highly exposed to flood risk today. And if you look at 2024 alone, so 2 years ago, a third of new homes were built in places where by 2050 we're expecting to be extremely prone to flooding. So the protection gap can build based on where we're building houses, but also where houses currently lie. And I think that's the element of which I'll close on, which is it's not just necessarily the biophysical trends or what we will see. It is about how are we actually building our economies, which will leave us exposed if we're not putting in resilience measures.
It's a really interesting point. So there are signals that are coming from the underwriting side, but they're not actually being priced on the investment side, particularly here in the case of flooding and buildings. So we'll come back to a few of the points you made, particularly on the public-private models. But first, I wanted to turn to Esther. As reinsurers have a uniquely long and global view of water-related loss trends. So from Swiss Re's view, how are these trends shifting from your perspective, and what does it mean for how primary insurers, governments, and the public sector should be thinking about water-related risks in the years ahead?
Thank you very much, Laila, and equally thank you very much to Banco de España for having us here. Yes, I'll be giving a global perspective. I would like to touch briefly on the protection gap, the loss trends, and the importance of prevention and adaptation. Globally, natural catastrophe cost 220 billion losses worldwide in 2022. Of those, almost 50% were covered by insurance. That was a record high. It's still only 50%, but I think it's also a bit of a positive message today when we talk about the protection gap. And we have already heard it is more typically higher. The insurance penetration is typically higher in countries that have some form of national scheme, be it public-private or not, but France, Spain, Switzerland, UK, these numbers, what is insured is higher, but we still have many countries, even in Europe, where it is much lower, especially central, eastern, and southeastern parts of Europe, where often even less than 20% are insured. And I'm not even talking about Asia, which is also highly exposed to flood risk, where also typically less than 20% are covered by insurance. But more can be done. So it's not only that insurance becomes difficult in places, but it is also more that can be done around the world. I find it important to note that until about 30 to 40 years ago, flood has been widely considered as very difficult or even uninsurable by the private insurance industry. I remember when we published a report in the late 90s called Floods Are Insurable. And it caused a lot of debates with our clients, but since then, a lot more risk have been insured, and thanks to advances in probabilistic modeling, computing power, data analytics, the industry has become better and more comfortable in assessing the risk and providing cover. Yes, there are areas where it's more difficult, and it's becoming mainly in an affordability challenge. But as I say, in many countries, more could be done to stimulate the demand. Actually, it's not so much a problem that there isn't sufficient supply, but people and businesses are often not aware of the risk, think it's not going to hit them in the foreseeable future, or rely that the state would chip in. And we have seen changes in law in the last 2 years in Italy and Greece, where it has become mandatory for all businesses to insure against a certain set of natural catastrophes, and Portugal has just recently announced to also introduce such a scheme. It has been said losses are increasing. We see an increase of around 5 to 7% annually in real terms in terms of insured losses. What we call secondary perils, which is an ugly term, it's not, you know, the insurance industry started to model first earthquake and storm risks, and so all the others that have come later into the modeling landscape were considered secondary perils. But what we really mean is floods, severe convective storm, wildfires are now the fastest growing segments of insured losses. But also important to note, more than 80% of the global increase in weather-related insurance losses is driven by exposure growth. And what we mean that is more people, assets, and infrastructure are concentrated in heavily exposed areas. So soil sealing, insufficient drainage systems, and rapid urban expansion are amplifying runoff and loss severity. So that's why the topic has been mentioned of prevention and adaptation becomes so important, and we see clear evidence that it works. Again, in countries like Switzerland, but also UK, France, flood losses have been materially constrained with respective investment through flood defenses, better water management, and stronger prevention measures. Research shows, this is interesting, that adaptation has reduced European flood economic losses by around 63% since 1950, largely offsetting the increased flood risk from hazard shift and floodplain expansion. So the question is really, are we keeping up with those investments, where we have seen big benefits? We have, a while ago, acquired our own a flood modeling company called Fathom. They estimate that UK household flood losses would be about 2.8 times higher without existing flood protection. So the message is water risk is rising, but there are also ways to deal with it, both on the investment, prevention, adaptation side, but also doing more on the insurance side. The regions that invest in flood protection, drainage, land use planning, and better water management are seeing the benefits. And clearly we have seen that also in the floods in Central and Eastern Europe, Storm Boris, where losses were lower than would have expected 10, 20 years ago with the measures that have been introduced. I'll get back on a few other points later.
Thank you. So some positive messages there about the insurance sector becoming more comfortable with flood risk, and also the need and I guess the scope then for increasing on the demand side. But the 220 billion figure, it's interesting because 50% is positive in the fact that's increasing, but that's still of course 110 billion that's not covered, which is quite striking. And particularly with secondary perils increasing, including flooding, and as you mentioned, increasing economic value in exposed areas. And I do like your point on well-designed adaptation measures that can that have a return on investment and that are critical infrastructure. So a question perhaps that we can come back to afterwards is, so what insurers are playing in this role upstream, as well, what role they're playing, and also who's coordinating between insurers, government, private sector to work there to make this change happen. But before we go back to that, a fundamental issue is how to make sure that this remains a shared responsibility while these risks are materializing, and that insurers are remaining engaged in risk transfer while adaptation measures are scaling in parallel. So with that, I'll turn to Francisco. So the Consorcio de Compensación de Seguros is one of the most developed public-private insurance schemes for catastrophic risks, including, of course, water-related disasters. So how does the Spanish model handle water-related risks in practice? Can you tell us about the design choices that have held up under pressure and the ones that are being tested as water-related losses are increasing?
Well, good morning, thank you. Thank you for your question. And I join my previous speakers previous colleagues in thanking Banco de España for the invitation and for generous hosting of this meeting. Indeed, Spain has, and we were referenced many times yesterday afternoon, we have quite different approach or a bold approach to the mutualizing of certain risks. Obviously, the system wasn't thought thinking about climate change or climate change adaptation because it was founded in 1954, but the principle is valid and still is in use, which is to mutualize a list of extraordinary perils that must be covered in every insurance policy. In most property policies, in all personal injury policies, and in all business interruption policies. That means that if you insure this building or your home in Spain, you have to have a list of perils covered: flood, windstorm, earthquake, volcanic eruption, tsunami, and also human-made perils such as terrorist attacks, civil commotion, etc. So we make a pool of different uncorrelated perils, and we finance this scheme by applying a surcharge to all those policies, which in total today are 144 million across the country. It means that we are mutualizing all these risks between every property, and Spain is a very varied country from a climatological point of view. We have 13 different climates only in the Iberian Peninsula. So we have different areas which we can compensate when climates with the others. And we have we apply a flat rate because some parts can be more prone to be affected by a flood, whereas some others can be more affected by an earthquake or by a windstorm or by a terrorist attack. Therefore, the premium is flat for everybody, and it's quite cheap in general. So it's, for instance, a typical household in Spain is paying a surcharge between 50 and 20 euros per year. And that's all. But we are covering 21 million residential properties. Therefore, we have, if in Spain, 80% of the homes have insurance, and insurance is a voluntary thing, 80% of the residential households, of the residential properties, have flood insurance. And that is a very powerful tool to cope with adverse selection, which is a problem in which, if in some countries, those who are more prone to be affected by a given peril have to pay more premiums, and that potentially can drive market failures or unaffordability issues. For instance, in Australia, 15% of the homes are paying more than a month's wage income per year. for their insurance premiums. Therefore, there is an issue by means of which those that need protection the most, and I think that we all agree that insurance is a very good tool to provide, for starters, economical resilience, and in a second step, physical resilience through many ways, premiums, deductibles, investments, etc. Our scheme is, I believe, good in trying to eliminate this adverse selection and try to provide a universal cover for everybody. Indeed, in October 2024, our system was tested by the hardest test possible, which was actually we had our PML in Valencia, this is the like Esther just said, it is the combination of a very large exposure. Valencia is the third city in the country. In the metropolitan area of Valencia, 2 million people are living, and in the area affected, about 200,000 people living, with a lot of industrial compounds, logistical infrastructure, etc. And it was very much hit by a very intense precipitation, which is not at all abnormal in the Mediterranean, but it's becoming worse. Mediterranean is becoming a weather bomb. It has always been so, because by the end of the summer, the sea surface temperature is about 20, or used to be about 26, 27 degrees, and now it's reaching almost 30 degrees. So that's adding more moisture to the atmosphere, and that is exacerbating the already existing problem of very intense precipitation when the first depressions at the end of the summer and the beginning of the autumn are starting to pass through our latitude. So this combination of effects was the trigger of about 5 billion loss for us, of a very sad loss of life as well. And well, our system, we believe that it provided a good answer. About 6-7 months after the catastrophe, we reached the 80% of the claims paid, thanks also to this public-private partnership that we have in Spain. So we had in like 10 days, we reached an agreement with private companies so that they could help us assess the loss and file the claims. Normally, when there is a property affected by one of consortium's perils, it is us directly filing the claim, assessing the loss, etc., and we pay the loss directly to the policyholder. That's why we are a direct insurer, unlike our philosophical cousins, which are our friends' neighbors, in which this public-private partnership is implemented through our reinsurance company. We are a direct insurer. But in this case, the number of claims was so high. We are talking about 250,000 claims in one afternoon, and we had to call in the companies who voluntarily accepted the challenge, and they handled and assessed half of the claims, roughly. Within speaking, you spoke about cars, for instance. In Valencia, 144,000 cars were affected. There are 40 countries in the world that have less cars than the ones that got affected in Valencia. So yeah, the size of the impact is terrible, or was terrible. But I think that we kind of passed the test, and obviously, we have created a lot of information that we are willing to put in the hands about very granular and about how and where the affection was produced, not only in Valencia, along our history, and we share this information with all those administrations and agencies that have to deal with with a peril, so that I think that we can continue making this virtuous circle grow of providing an answer first, because if insurance cannot step in because of premium prices or affordability issues, insurance stops being relevant. And I think that the challenge here is to keep insurance being relevant in many ways, and one of them is, for starters, adding response capacity to society by indemnifying economic losses, but also providing information on the physical damage so that others can jump in and do something in terms of land regulation, building codes, etc.
Thank you. Some really, really interesting points there. I just wanted to go back to the design, really, on focusing on availability and affordability in the program itself. And so through compulsory coverage to prevent adverse selection and national mutualization by binding these uncorrelated hazards. So just on the design structure itself, and the fact that you have this experience of the Valencia floods, which I think most people are aware of, and that it actually stood up to the test of it, and there are some important lessons that have been generated for the program. So let's move to Christopher. We'll come back to everyone in the second round of questions. But so Christopher, you have the unique perspective on the panel from the GWI and really having this overview of the water sector as a whole. So from what you've heard from the panel so far, what would you want to tell insurers about where water-related risks are concentrating, how the sector is reacting, and what the insurance sector actually might not be aware of or should be preparing for?
So give you a bit of a backstory about how we've approached this as an issue. So 2 years ago, we did a piece of research looking at the MNET data about trying to quantify what proportion of the cost of climate change would fall on the water cycle, i.e. looking at water-related risks related to climate change and what proportion of the total sort of climate-related insurance payouts there might be. And we found that it was something like 69% of the sort of impacts of climate change were in the water cycle from an insurance point of view. And we could see that it was growing quite quickly. So last year we did some research with NASA looking at the correlation between extreme weather events, i.e., the way that they measured it is sort of floods and droughts which are greater than one standard deviation from the mean, and how that had changed with the rising temperatures. And there's quite a sort of alarming correlation, as one can imagine, that as temperatures have risen, we've seen this extraordinary kurtosis of the water cycle, i.e., it used to be more like that, and now it's more, the extreme events are more extreme or more intense, and the sort of mean, it becomes less frequent. That's the sort of trend that we're seeing. And last year was actually a relatively cool year compared to the year before because of the La Nina. But if we are moving on to El Nino in the late half of this year and into next year, I think we'll get back on that very strong trajectory of this kurtosis within the water cycle, which is going to have a huge impact on the way that sort of, I guess, insurers think about these things. But we also did a piece of research this year looking at the sort of relationship with sort of water and the new economy. Here it's sort of, obviously that sort of AI story with data centers and semiconductor fabs and so forth, and how they're interacting with water. And I think one interesting thing to look at is, when you look at the impact of the war on the energy sector, it's been quite delayed. You've had this something which is a sort of what one would think is a quite catastrophic event of having a decent percentage of the energy taken out of the sector. But because you've got long supply chains, large inventories, the nature of this old physical economy actually has got a lot of ability to absorb risk in it, which doesn't exist in the AI economy. If you have an outage, in a semiconductor fab, it can cost, just in terms of lost production, you can lose like $400 million in a day as a result of your water not being there. And similarly, with some of these data centers, the losses can come quite immediately. If you've got one of these big hyperscale data centers and you don't have water on that hot day in summer, when you're sort of needing to have it, you can fry $1 billion worth of chips like that. It's sort of serious sort of economic risk. And what one's feeling is that the global economy is moving towards this always-on, 24/7, short supply chains, no inventory, nobody working in shifts, which is much more exposed to these environmental shocks than a more traditional economy like the sort of energy that we've seen. So, the theme of our conference this year was something like delivering the water transition. We know we need to have a transition in the way that we manage water in the same way that we have had in the way that we manage energy. And, Sophie very kindly came up at on the opening panel to talk about this event and this question of how much of a risk to the financial system these things that we've been observing are. And we asked the audience, what do they think? We gave them 3 options. The first option was it's an immediate risk, but a regional one. The second option was that it's not an immediate risk, but it is definitely one in the long term. And I guess that the people who voted for the third risk basically took the view that this meeting was therapy for Europeans who didn't want to talk about the real risk in the financial sector, and i.e. water wasn't a risk at all. The top, I can't remember, something like more than 50% said that they thought that this was a longer term risk rather than something which is immediate, but probably about a third thought that it was immediate but on a regional basis. And I think that this regional thing is interesting because when I've talked to people about it, it's not the risk itself that they think will knock over the financial system. It's the way it interacts with other risks which are happening at the same time. So, for example, at the moment, the sort of big anxiety in the water sector is around Corpus Christi, which is, I think, the biggest, or second biggest LNG export center in the US. And, they're going to run out of water unless the sort of rains arrive by November. And, if you have that LNG port getting knocked out at the same time as Europe and other parts of the world really needing a lot of LNG from the US as opposed to the Gulf, you start getting these sort of accumulated risks. So we also had a bit of discussion of who was going to be paying for this water transition we wanted, and we put it out to the audience to ask who they thought, and it was interesting that the insurers were sort of pretty much off the hook. I think that only 5% of people in the room felt that the insurers were the people who needed to be thinking about investing to reduce these risks. I find it quite interesting here that a lot of the way that the insurance industry seems to be thinking about this is, yippee, this is an opportunity, we've got a captive market, they've got to insure, and we can start pushing up the premiums to cover ourselves. Because insurers are very good at dealing with risk. And, you can see that this could be a good opportunity to build things out. But I'm not hearing this discussion of, how are we as the insurance industry going to use the funds that we invest to reduce those risks overall. And I think one of the things which I feel is that there needs to be a sort of reallocation of capital, that currently probably less than 1% of global assets under management are allocated to water-related investments. And that we probably need, if we're going to get through this water transition, to have that more like sort of 5% of assets allocated to water-related investment. And I would have thought that the insurers should be the people who are leading the way.
Thank you. A number of really interesting points there, and I think I'll give the panel a chance to react in the next questions. So I'm determined to give some time for questions at the end of the session. So I'm going to go into the next questions, but let's try and maybe. I'm sorry, my questions are also very big, which is an issue. But so we'll try and do the 2-minute answer on these ones. So I'm going to start off with Nicolas, going back to you again. Yeah. And I think looking ahead, because in this part I really want to focus on what next. So, what policy and regulatory changes really do you see that are needed that sit beyond the industry's own control, and what can the industry do differently? Those two parts of the question. And actually, given that we're in this room and there are supervisors here and government as well, what would you want them to keep in mind as well and to know? Okay.
Yeah, thanks very much. I think in terms of maybe the second part on what the industry can do differently, I think what we are seeing really currently is an increased focus on prevention. So, and I think this is not new. Prevention is really a core part of the insurance business model, but in a way you could argue that with risks becoming more severe, more frequent, it's not a nice to have anymore. It's something that has to be scaled up very significantly. And we see a lot of initiatives where insurance companies are advising on how to reduce risks very concretely, going to buildings and saying this or that has to change for the risk affecting that building to be reduced, etc. We see initiatives also, for instance, in France, in terms of there are tests being made on how buildings exposed to subsidence risks could be retrofitted in order to reduce the risk affecting those buildings. We have listed, in fact, a number of those initiatives in which the insurance sector is involved in the booklet in the position paper that you mentioned. And I think this is something that's happening now at a larger scale than used to be the case maybe a couple of years ago, and probably this is a trend also because of new, as I mentioned, there are also possibility to use new technologies, AI or digital tools in order to spot leaks or to spot a wildfire as soon as it is happening. So I think we need to make use of these tools in the right way in order to increase prevention, therefore reduce exposure to risks. In terms of but again, I would really stress the point that the insurance sector is part of a bigger chain, bigger picture, and so there will be a need to increase partnerships with authorities, supervisory authorities, local authorities, national authorities, in terms of how altogether measures can be defined and taken in order to reduce basically the risk exposure and the vulnerabilities in order for, to quote PACO, for insurance to remain relevant. And then there is probably also an element of investment, certainly, but here I would say that, of course, the money that insurers can invest is in the end the money of policyholders, and there is a need for the money, for investment to be an investment, so it has to meet certain conditions, such as generating a return. Otherwise, it's not considered an investment, and it would not be prudent for the insurance company to just allocate the money just to reduce future losses. So there is a need. I think it is very important. The insurance sector can play a role in financing some of that transition, but the model needs to be defined, and there is a need for that to happen in a way which also avoids free riding and that sort of things. I mean, it's a complex question, an important one, and certainly one that could be discussed during a panel. And maybe a message to the supervisory committee, regulatory committees would be probably it's really good to have this discussion. We should look at it from the different aspects, and we should probably not rush into conclusions that, for instance, the regulatory framework needs to be adapted. Again, we have a sophisticated regulatory framework, which I think is fit for also future risks. Doesn't mean it shouldn't be amended here or there, but I think we should build on what we have and look concretely whether we have the right tools in place, which for me is largely the case from that point of view, and we need to be careful before changing what we have, which works well. Yeah, that would be my points.
Thank you. Over to Esther. How can reinsurers, governments and investors work together to ensure that growing water-related risks remain insurable and affordable?
Yeah, $1 million question or euro question. We have to work more closely together. The how is, that's why we need these discussion rounds and forum to talk to, those outside industry and policymakers, regulator, etc. I think it's important to recognize that insurance is, an important mechanism to compensate after loss has occurred. The first priority must be reducing the risk as much as possible to keep insurance affordable. But the important other aspect is that insurance puts a price tag on risk. And that is an important signal for the entire economy, for all the different players in the market. And that price signal also needs to be taken into consideration by all market participants in the economy. And that also means we need to invest in risk intelligence and continue to invest in assessing the risk. Looking at past historic data is not enough. We need to look into the future, invest into modeling, improving the data, because a lot of these events are so localized that we need to improve to really have informed decision making. And then this information can also be used to inform prevention and adaptation measures to calculate the best benefit cost ratios, what is worth investing, what gives the biggest return in terms of losses that can be avoided. And we have done some analysis, and these benefit to cost ratios range from 2 to 1 to more than 10 to 1. So for every dollar spent or every euro spent, $2 or $10 can be avoided in terms of future losses. Or even more. There are examples out there with fantastic ratios. So and we also we make our models increasingly available to other partners, large corporates that have factories around the world. Banks are increasingly using our tools to assess the exposure of their mortgage portfolios. We employ more than 60 scientists and run 200 models globally, so we are very committed to engage more actively. Such that, resilience must become a core economic and investment priority. And then also the discussion about public-private partnerships in terms of how we can increase the insurance penetration in the different countries, such that these residual risks are being insured. And again, we see still in many countries, a lot needs to be invested to make people aware and to create incentives or even some form of obligation that households and businesses are being insured, such that these losses are not ending up on public budgets. There's also quite some innovation going on in the insurance industry, and we are very active in that, in developing alternative forms of insurance, so-called parametric insurance, that make payouts based on physical parameters, amount of rainfall in a certain location, extent of flooding in certain areas. And these instruments are particularly suited to cover losses that traditional insurance does not cover. Emergency intervention costs, public infrastructure that is very difficult to insure on a traditional basis. There are also such new instruments. We are very happy to engage. So I would say, to summarize, flood losses are highly responsive to adaptation if governments, insurers, infrastructure planners, and investors act early and collectively. We can materially reduce future losses, narrow protection gap, and preserve long-term insurability. To your point, if we reduce future losses, that also has an impact on the prices. And we also see really positive impacts. Australia, there are several examples where, thanks to big investments, premium rates came down 30%, 35%. In Switzerland, the charge for natural catastrophe by private insurers, we have a complex system, but in the private system, over the past 20 years, the premium rate for natural catastrophe has been reduced by 30%. So I'm just saying this pays off, this investment.
Thank you. So maybe jumping to Francisco, and maybe we'll just focus on one point here. But this is obviously a very successful model in Spain, and I think there's important lessons for other countries in this. So maybe one key point is, so I think maybe just what are the key points that you would want the international community to know about this scheme and how it can be replicated, and the specific, what they should keep in mind?
Yeah. Well, we never try to proselytize our model. We were very well aware that this is a model that works in Spain, that was developed in Spain for the, it's like the railway trucks. They develop with the history and with the geography of a country, and it's very difficult to replicate the Spanish railway system in Congo. It's different, the conditions are different, and the historical evolution of it is different. Therefore, we having absolutely no interest in selling anything or in preaching any new reality or whatever. It's true that we have some ideas that when we are asked, we share. For starters, the main point is that we are not here to represent any hindrance to the market or to eliminate market opportunities for insurers or reinsurers. I think that we all have a space, and I think that when you have a broader insurable mass, you have a bigger insurance penetration, you have more business for everybody, including international reinsurers. Therefore, we are not there to hinder market. We are to foster market, actually, and to make markets work better. Taking into account that it is not our priority, the insurance companies. Our priority is the people, the insured. So that's something that we always have in mind. And it's also an important point that to maintain moral hazard at bay, we are sharing risks with the market. Not all water risks in Spain are covered by us. We cover flood, but all the direct effects of precipitation, hail, which is an important risk, leakings from the roofs, snow, all those are directly covered by the market, and they reinsure, and they have a capacity that we don't, which is subscription. So they can control moral hazard by having skin in the game. It is important that every actor keeps skin in the game. Therefore, you don't externalize your losses to a third party. So that's not the idea. The idea is to complement and to make the system work better. And we also give policyholders skin in the game. We apply deductibles for industrial and commercial properties, not for domestic economy, but we do those that represent larger losses, which are industries and large commercial shops, etc. they have to pay a 7% deductible. Therefore, I think that the idea is to develop a win-win situation adapted to any country. Not all perils, for instance, in Portugal, wildfire is a relevant risk. We are not covering wildfire in Spain because it's not material from the insurance perspective. In Portugal, it is. So it might make sense to design a system in which all those hazards that are affecting more the people are bounded into this kind of compulsory extension if they want to try to replicate some ideas such as ours.
Thank you. Moving to Thomas. So what does it actually take for an insurer to move upstream from risk transfer into actually shaping risk itself? And where are the institutional and regulatory barriers that even a willing insurer runs into that need to be addressed?
Great, thanks. I know we're conscious of time, so I just want to give some really practical examples of what we're doing that plays to some of the stuff that's been said. I mean, I'll just start by the point that's already been made about what we can do is price, manage, and transfer risk. What insurers can't do is absorb systemic risk indefinitely, period. What I also want to give the examples is, I'm not going to, also into a spirit of time, but can talk about it afterwards, is what we're doing is in the round of, as you mentioned, we're an asset owner. We have investments in sustainable assets that include infrastructure. We have ambitions, interim ambitions we've met, but we've set this out in our second iteration of our transition plan, which sets out how we have a balanced or increasingly balanced focus between mitigation, which is the best form of prevention in terms of net zero, but then also adaptation as well. But to give four tangible examples, and I'll try if I can, although it might not be a strong link to relevance for central banks and supervisors. The first is what we can do in terms of our insurance and our claims in the event an event happens. And I think both of these examples, I think, have behavioral elements that will be interesting for a central bank or a supervisor to see, recognize, and particularly the impacts on household balance sheets. So the first is if an event occurs. If a flooding event occurs, one of the things we can do, and we are doing increasingly through a Build Back Better scheme, is we can offer through our claims processes suggestions, claims, associated payouts, money to households about supporting resilience measures that they can put in place in their homes so that next time the impact or severity would be less. Now, crucially, the ability of that uptake depends on the behavior of the household. If the household wants that, it can take it. If it doesn't, they don't. So I think what we've seen globally, or what you can see globally, is actually for measures like that, and again, it's not immune to the UK, there's actually relatively low uptake from consumers for that. And that can be, in part, explained, as I mentioned, if you are displaced for 9 to 12 months, your priority is getting back to normal. You necessarily won't think in the very immediate term of planning resilience beyond, but I think that's a broader behavioral question. The second is, what can we do before an event? Now, we obviously live in an age where there's a huge amount of information, there's lots of reports, there's lots of news articles, but what we can do now, through the beauty of everyone in this room has an iPhone, or any other phone, sorry, I'm not just plugging Apple, is you have apps, and apps can give you information before an event. So one of the things we've recently released and pushed out, particularly to customers that are in high-risk flood areas, is an app that will tell you, give you an alert when a flood is expected to happen, and that obviously draws on data that we know and we all collectively know. It gives them information on what they can do to prevent the severity of impact, and, if possible, gives them a personalized plan of what they could do from a broader set of prevention. So that's using technology of this age, not past age, this age, to give high-risk customers the information they need when they need it in the most accessible form. So again, we'll see how that plays out and how it is used and what the impact, but again, I think about providing customers with means of information in a way that we would use it today is paramount. Now, those are things that from an individual point. We've talked about systems yesterday, and you talked about, and we've heard it on the panel, two tangible things we can do from a systems perspective, or are doing rather. The first is being very clear, as you probably saw from my first answer, that ultimately this is a real economy policy issue. But what we can do is we can lean in and be very specific on that and what do we mean in terms of things that we think could help mitigate risks that obviously are sourced in the real economy. So one of the things we have done through our Building Futures community work, which we've published, is set up very transparently 6 areas of policy asks, covering, and I won't cover all of them because they're public, but covering about planning, planning approvals and planning in high-risk or expected high-risk flood zones, the ability of homes to have sustainable urban drainage systems, and that obviously affects town and city planning. And third, which I want to build on, is scaling up natural flood management, because we know natural flood management has a huge number of benefits if done well, but at the moment isn't kind of scaled in terms of the amount of public, even public, but private funding that goes into it. Now, it's all well and good for us to say, let's scale it up, and then leave it at there. But we know that when it comes particularly to natural flood management and you're looking at the benefits, which ultimately are adaptation-related benefits, there isn't an obvious revenue stream. You know, who will pay for the benefits of increased adaptation or resilience? Highly local, highly contextual, depends on where you are, particularly in terms of a water catchment if you're upstream. So one of the things we are doing that was launched last year was we chair a new coalition in the UK that's called Flood Action. This coalition has insurers, banks, landowners, NGOs, involvement of government agencies with a clear ambition to actually build and scale a water-resilient market in the UK. So we're supporting natural flood management or nature-based projects in the UK and actually crowding in private institutional capital. Now, that takes time. One of the things that we are doing or increasingly doing is first you need to identify the project pipeline. So when it comes to something like natural flood management, in some sense it's quite easy because we know where the catchments are in the UK. We know we can understand the beneficiaries around that. And so working with those stakeholders I mentioned, you can really start to paint a very clear picture of where you'd have scalable, sizable projects in terms of natural flood management. The second bit is the financial mechanism, and that's looking at the beneficiaries of if there was investment in a certain catchment, who ultimately would benefit in that surrounding area. And so from doing that, we're exploring the development of catchment companies in terms of kind of financial models or financial instruments, and that can actually work into start getting revenue into these projects and actually commercially scale. So again, it's working with others to actually scale investments into an asset class that does not exist, but needs to exist if we actually want to support adaptation and resilience at scale.
Brilliant. A lot of really interesting points there. So I wanted to briefly hand over to Christopher to react to what the panel has just said and actually ask them a question. And I know we don't have a lot of time. I might call back 5 minutes because we lost it at the start. So one question from you, and then we'll try and take at least one question from the audience.
Well, I guess that my observation is that the insurance industry, including the reinsurance industry, insures covers a lot of the risk, but ultimately it's governments who mop up most of this systemic risk associated with this. And we've got to this situation, and this is where I think central banks and others have to be interested, where the public balance sheets are both overstretched. Governments have got huge deficits all over the world, and they can't invest more money in mitigating their risks. And they're also overexposed to those risks. And so you have that sort of nice, well, terrifying correlation between overexposure and overstretched, which one feels is going to get worse unless we see more private capital sort of getting involved in addressing those risks. And as I see it, there are sort of two sides to this. I mean, a few years back, I was involved with the Global Agenda Council on Water for the World Economic Forum, and we thought, hey, maybe there's an income stream which will make these things fundable if we can infrastructure investment for reduced in exchange for reduced insurance premiums. And we went to speak to the Insurance Global Agenda Council, and they told us to go away because they'd have their black boxes, and they didn't want to open up their black boxes to explain their risk models, which would be necessary in order to do that. But I think more generally, there is this question of that's what the insurance companies could do to make it a little bit easier to attract private capital into this. But I think they're also, to this point that, you know, what I think you were sort of implying, Nicholas, that water's a bloody awful investment, so what the hell? Actually, it can be a great investment, but it actually needs, you know, more engagement, you know, with governments to say, hey, we can help you with this, you know, and you know, because at the moment it is, you know, all of this infrastructure stuff is very much on the public balance sheet. And, you know, creating those models which make it investable and make it into an attractive investment is great. You know, it is something which, you know, if you can invest in long-term water infrastructure, you know, it has relatively low sort of variability. I mean, it is a halo asset, whatever it is. You know, heavy assets, light, what's the O stand for? I can't remember. Obsolescence. Water's never going to be obsolete, so it is a good thing. So I guess my challenge to you, to the insurance sector is, can you engage with this, you know, on the capital side, to address this this risk, which is, as you say, systemic and growing?
Who would like to react?
I mean, I can keep it brief. I mean, obviously, hopefully I've displayed we are engaged. Hopefully, you know, we want to do it in collaboration. All our things are in collaboration, but always happy to collaborate more on something.
Agreeing with Nicolas has been saying before, I mean, infrastructure and including water infrastructure, this needs to become a clear asset class with clear revenue streams, and then insurers also can invest more easily in that. We are part of an overall effort that was created through the Insurance Development Forum to create an infrastructure investment fund for where insurers are participating, including us. So there is progress, but there is also more need to make this an investable asset class.
Mm-hmm. But in our case, being a state-owned company, being a public company, puts us in a very good position to talk to the government in terms of sitting in, for instance, the national flood directive implementation table and speak to, as I said several times, to speak to those agencies that have the competencies to manage risks. So it's, we are in an interesting position to talk to the private market and to talk to the government and to the agencies. And I think that's another good point of where we are here in Spain.
And maybe I would say that the objective of increasing insurance penetration is, of course, a valuable one. I think Esther mentioned before that the proportion of losses that are covered are at a historical high, and I think this is the objective in order to share in the end the burden of losses. And there are various ways to achieve that, which I think we have explored, one of which is really to do more in prevention, but also have a more of a risk culture where ownership of the risk is being taken by a range of stakeholders, including policyholders. I think this will be important to acknowledge that there is an element of the responsibility which falls on policyholders, whether they are individuals, of course, to the extent that they can do it, and there can be support for that, but I think there will be a need to take more ownership of risks, also companies and public authorities. And I also agree that the assets are important, and there is a need to look at the investment capacity of different players, including insurers. I think it's really a range of ways that need to be explored very seriously in order to address the concern that you have expressed of the fiscal burden and that is growing.
Okay. I'm going to take one question from the audience, and everyone has a 30-second answer to it. I'm sorry. So I see multiple hands. I am going to go for... sorry about this. Kate, as you have the session afterwards, I'm sorry, I'm not going to give it to you. We'll go here. There you go. Please, the gentleman on the side here. No, that's you. Yes.
Works? Yeah. Hi, my name is Marcio Viegas, my cousin there. Founder of Sustain, and also I'm an independent researcher. Well, first a just a reflection, don't need to answer on this, but I think that a critical role for insurance is not to provide insurance, for instance, to the fossil fuel sector. But you don't need to answer this, but let me talk about two pieces of research we published. Last year, for instance, we did research on the role of insurance and how to reduce and prevent risks. And when we made a few recommendations, and some of them are popping out here today. For instance, the Build Back Better, which is something that I would like to hear from you. What are your thoughts? And also things like parametric insurance mentioned by Esther, for instance. What are your views on parametric insurance? But also, when insurance is too good, you may have a moral hazard. So how to deal with that in nowadays? And we did another piece of research 2 years ago on the role of insurance as the insurance sector as institutional investors. And one of the key or innovations was these catastrophic bonds. And maybe from my cousin, from Thomas, and many views on how you're investing or you're issuing catastrophic bonds, but also maybe from Swiss RE, your views on cat bonds, please. Thank you.
Okay. Brief answers. Maybe we can start with Nikolai, if you'd like.
In 30 seconds, it would be, we need another panel.
Maybe you just answer one part of the question then, and we'll share it across.
I mean, all very good points, certainly, and I think all of it is part of a toolbox, really. Parametric insurance, cat bonds, everything that can increase capacity is important, and also we need absolutely to avoid moral hazard, so there is a need to have systems which are increasing the coverage in a way, but also make room for price signal. That's very important.
About moral hazard, well, you know, we've spoken many times about this short blanket problem in which you have to decide if you address adverse selection or you address moral hazard. In our case, we address adverse selection. That this is a very theoretical issue in terms that we are there to provide a solution for people. Barcelona, Valencia, Malaga, Paris, London, New York are floodable areas. What do? We don't provide insurance in London or in Paris so we have to come with a solution. The solution, the problem is already there, and obviously you have to reduce vulnerability and try to reduce exposure as much as possible. But there is an existing problem, and you have to provide an answer to it. So we are always not denying that we have some capacities, and I said in my previous intervention that to try to control moral hazard, our main goal is to be relevant and provide an answer for people.
Yeah, insurance plays an important role in creating economic and societal resilience, and we have an interest to remain relevant. So that means we have an interest in helping to reduce the protection gap and an interest in keeping insurance premium affordable and reflect the investments that are being made. There are new ways of providing insurance, parametric insurance, cat bonds. They have their place. They are toolbox, as was said, specifically suitable for risks that are traditionally not insurable, so they can help reduce the protection gap for those risks that are difficult to assess, that are maybe dealing with moral hazard, as I mentioned, emergency intervention costs, infrastructure costs. Swiss Re is among the largest sponsors of cat bonds in the world.
And I think we'll end on a quick answer from Thomas.
Sure, well, it's great to know I've got a long-lost cousin. I'd like to, it'd be great to see that research, will be part of the answer, but I think more generally, I'll kind of stay on the parametric insurance. I guess for me at a high level, the ability for it to support ex ante, what can it do actually that to really support building the resilience ahead? But then second, and I probably need it to be full of thought, the extent to which, given the biophysical environment, the kind of core underpinning assumption and limits in parametric insurance, how viable are they 10, 20, 30 years down the line for a particular ecosystem or particular area, I think is a subject for deeper debate. but it's not necessarily apparent to me that the parametric insurance of 20 years ago, the model would necessarily be the one 20 years from now.
Okay, well, thank you very much to this excellent panel, and I really appreciate it. Apologies, Josefina, for running over slightly, and I think we'll hand over now to the next panel. Thank you.